Hey, good morning, everyone, and welcome to our webinar on using the brand new spreadsheet that Joe Massey just released. So today we're going to talk about the version 6.0 of the investment property analysis spreadsheet, and we'll give you the access to download it after we're done today's webinar. And we're going to make this hopefully a cornerstone piece of content. And by that I mean we're going to go into some details, go through a couple examples, ask those questions, because once this webinar is recorded and over, we're going to throw it up on our websites. That way you and future clients and future investors can go out there and check out the recording of it. So before we jump into it, disclaimer, we will be talking, finances, some tax stuff. Make sure you always seek out the appropriate expert advice that you need to go out there and do your own due diligence on buying and investing your own money. Joe and I do our own work. I'm an agent. He's a lender. So we're good in that field, but there's always other stuff to consider. So make sure you're seeking the appropriate help out for that. So who we are, my name is Chris Lopez, and I'm a real estate investor and also a real estate agent here at Your Castle Real Estate. And my primary investment and motivation as an agent investor is for all buy and hold properties. I don't do a lot of stuff on the fix and flip world. I like building long-term wealth and focusing on the financial component. So I do that to helping people buy rental properties and also do the house hacking and nomading method to buy rental properties, which are both really, really powerful ways. And my partner today is Joe Massey, who is the senior loan officer at Castle & Cook, who does not only investment loans, but also all types of residential loans. So, Joe, good morning.
Good morning, Chris. Great to see you today. Really excited to be here on the webinar and really excited that we're recording this. As you know, our prior spreadsheets all the way back to version 1 from, 8 years ago. We've been using those, had a lot of positive feedback on those over the years. This one, I think, really adds a new dimension in analysis and options that we can look at. So I hope this will be useful for folks here on the webinar. And if I can ever do anything to help, of course, always call, text, email. Love to chat because this is what we do all day, every day.
So we're just going to jump into the spreadsheet here. And Joe, while I'm zooming in here, you mentioned this is 8 years old now, or you've had this for a while. What's the quick history on this?
You know what? I had a client a number of years ago who wanted to purchase some investment properties and was just struggling to analyze it and just couldn't wrap his mind around it. And the more I went over it with him, over the phone, and the more we broke down the numbers, he was a very sharp client, very good guy, but just could never quite grasp, here's how the numbers worked, here's how this worked. But he was a computer guy. And he said, man, if I just had a spreadsheet that I could put this into, it would really help. And he asked me that 3 or 4 or 5 times. And finally I said, all right, well, let me put one together and see what it looks like. And if anybody out there that's got the old version 1.0 of the spreadsheet, it was pretty basic, but you know what? It worked. And then it just evolved over time as people would say, well, what about this method of analysis? Or what about this change or that change? And now we're up to version 6.0 here.
Wonderful. So we're going to just start going through the spreadsheet here, just step by step. So, follow along as we do this, and always pause the future recording of this. So at the top here, we got our contact details and some links to additional resources, because a lot of times there are other training videos and resources associated with this. So make sure you check out the top up here. And as you watch this in future, look in the very upper left here where it says latest revision date, because every time Joe makes a minor update to it, it'll still be version 6. But hey, a little bug gets quirked out, or I give Joe a request to do something, we're going to update the latest revision here and put the date right here. I'll have it on the website. And if you're ever not sure, you can always email me, email Joe, and we'll tell you what the latest one is, and always be happy to give you that copy. So Joe, scrolling down, this is your baby. You explain.
Yeah, so go up just a little bit. I want to start actually with the instructions there. So the first time you open this, you might get a yellow warning at the top, especially if you're downloading it from the website or we're emailing it to you. Microsoft Office is going to protect you, and it's going to say, hey, this file has macros. It's got a lot of unknown stuff. Do you want to enable content? Do you trust these guys? Yes, it's coming from us. There's no viruses in it. There's no nothing, but you will have to click enable content. Then from there, you're going to work your way down the sheet, inputting the appropriate information in each of the yellow fields. You want to make sure that you input the correct number of units, and I'll show you why that's going to make an impact here in a little bit. And some of the lines have these little red carrots, I guess is what they're called, and it'll give you some tips there. All right, so if you're not sure, you can highlight one of those little red icons, and it'll tell you, here's some things to know about that. And then once you've completed all of the yellow fields, you can view your results on the following tabs at the bottom. So we'll go over how that works. So let's just do a practice property. We're going to put in the address. So 123 Main Street. And let's just say it's a single unit. But if you go there, you can select 2 unit, 3 unit, 4 unit. And then one of the things that's important there is that'll change your down payment requirement. So do 2 unit for a second. And then let's say we want to do 15% down, as we know that's an option that we have. It'll tell you, hey, you know what? You need a larger down payment. All right, your minimum down payment on a multi-unit is 25%. So the spreadsheet's not perfect. You can put in bad information and get bad information out, but it is going to help you with some of the obvious things. So go ahead and let's change back to 1 unit there, Chris. And let's just do 25% down. It's pretty normal. Purchase price, let's say it's a $300,000 purchase. All right, now acquisition costs, you'll see 2 fields here. One is acquisition costs and then one is loan costs. So these are the closing costs associated when you buy a property. So your loan costs, the spreadsheet's going to calculate that automatically for you. But then you're going to want to put in your acquisition costs. And these are going to be variables that you have the option when you're buying a property. How much do you pay for property insurance? How much did you pay for an inspection, a sewer scope? Did you get an inspection? How much are the transfer taxes? How much was your title insurance? Recording the deed, any closing fee? Did you buy a home warranty? Did you have to pay off a lien that maybe the seller didn't want to pay, but you were willing to pay because it was a good enough deal? So these are going to be your costs that you want to put in here in order to confirm this is like our total closing costs.
All right. So what should we put in here, Joe?
A $300,000 home, let's put in $3,200. Sometimes more than that, sometimes less. Initial repair costs. Now this is going to be, and actually let me take a step back. You'll see that it automatically calculates your down payment and mortgage balance for you. Go ahead and click there on that $75,000, Chris. So you'll see it doesn't let you click on that. No, you can't. So the spreadsheet is set up that it's not going to let you mess up the formulas. All right. So you can only fill out the fields that are in yellow. So next one, initial. Now I just got a message here. Someone lost audio. All right. Looks like hopefully it'll come back on in a moment. Initial repair costs. We're going to go ahead and put in here. Let's just say this property cost $5,000 to repair. Who knows? Maybe it needed carpet. Maybe it needs paint. Who knows? We just got a message that the audio came back on. That's great. Thank you. Interest rates. So interest rates are super low right now. Let's just plug in 4.5%, maybe higher, maybe lower, depending on your credit score, depending on how much money you put down.
Well, before you do that, Joe, let's jump back up here to line 27, your total initial investment.
Yeah.
So how is this calculated here?
Okay. So that is going to be your acquisition cost plus your loan costs, plus your down payment, plus those initial repair costs. All right. It'll automatically calculate that for you. So go back to initial repair costs. Let's just say this property needs no work. Type in 0. All right. It's a smaller investment, but this property does need 5,000. So let's go ahead and put 5,000 in there. All right. Now we've got our interest rate, 4.5%, term, 30 years. You can certainly do a 15-year or 20-year. Most investors do 30 years, and that's kind of a topic for another time on why that makes sense, but that's generally what most people do. Now, monthly rental income, $2,200 is what we have in here for unit number 1. Go ahead. Now, this is a single unit, but go ahead and plug in here $1,500 for unit number 2. Unit 2. So $2,200 unit 1. All right, so it'll tell you, hey, you know what? You've got this only as a single unit property. It's not going to calculate this rent for the second unit. It's, again, going to try and prevent you from, making errors if you're saying, hey, I want to put 15% down on this multi-unit property and then put in multiple different types of rents. The spreadsheet's there to help you watch out for some of those little errors. So go ahead and change our unit 2 rent back to 0 if you would. All right, so total rent on this unit, $2,200 a month. Next, we're going to plug in vacancy. So, Chris, what's vacancy? Give me a quick explanation on that.
Vacancy is how often your unit is empty. So this is when a tenant leaves or you just have turnover, and we generally use a percentage of your rough rental income. So great, if you have a tenant in there and then they're gone for 2 weeks, well, then 2 weeks divided by 52 weeks is a certain percentage, and your unit is vacant for that amount of time.
Yeah. Now, right now in Denver, vacancy has been historically low, gosh, since 2012, 13, 14. So, traditionally, I like to use 5%. Some people say 7 or 8%. Vacancy right now, I think, is less than 2, but I think that's, abnormally low. So let's put in 5% because we are doing a long-term analysis here. Now, annual appreciation. This is how much the property is going to go up on average year over year. Now, I know some years 10%, some years -5%, some years 8%. Chris, what's the annual appreciation been on average in Denver for the last 40 years?
Just right around 6%.
6%. That's exactly right. Now, I like to put in 5, again, just to be a little more conservative.
And if you guys do not agree with our assumptions, or you want to model different assumptions yourself, this is why these fields are in yellow. Because you'll be like, hey, I want to use a different appreciation rate. Cool. Plug it in there then. We're just giving you some basic guidelines to go after and give you a starting point so you can start analyzing properties and then plug in different assumptions to see how that impacts your investment.
Absolutely. So if you don't like our numbers, when you get the spreadsheet, plug in your numbers. That's the whole reason it's there, so you can customize it. Now, effective tax rate. So this is a new one that we've added. Can you highlight that little red icon there?
Of course.
All right. So your effective tax rate is not your tax bracket, but it's the overall percentage of tax that you paid. And the way you would calculate this is, let's just say you paid $50,000, or you made $50,000 last year in income, and you paid $10,000 in taxes. And 10,000 divided by 50,000 is 20%. All right. Now, everybody's going to be different. Everyone's going to have their own unique tax rate. And what you want to do is plug this in based on your individual circumstances. For this scenario, Chris, let's go ahead and plug in 25%. Let's say the buyer of this property is a high income earner.
And this is one of the reasons why we put that disclaimer at the beginning, because we are not tax professionals. You should always consult your CPA or tax professional to get your effective tax rate and get advice on what numbers you should be plugging in here for tax purposes.
Yep. And if you're not sure how to calculate it, look at the cover page that you get from your CPA where they do that 2-year comparison. It's always right there on page 1, 2, or 3, and it tells you, hey, this is your effective tax rate. That's the number you want to plug in there.
And what I do a lot of times is I use a website called, I think it's smartasset.com, or if you just Google it, you can get a lot of like template things. Hey, if you make this much money, here's your effective tax rate. Give you some ballpark numbers to start playing with as well, because there's always Mr. Google out there, which knows a lot of stuff.
Absolutely. Now, do you pay for property management? Go ahead and click on that. So you have an option here, yes or no. Let's go ahead and say yes, that we're going to pay for property management. All right. So now you'll see we've got to plug in there the monthly cost for property management.
And I want to interject here. So this is a drop down. If you click no, the field for your percentage disappears. If it clicks yes, it then gives you the field. That way it makes it more simpler and streamlined. That way you can say yes or no, then plug in the percentage that you're using.
Yep. We don't want you having to plug in stuff if it doesn't apply. So if you don't use property management, great, select no, and then you won't have to put in a percentage there. But in this case, let's say yes. And, industry average is about 10%. Some property managers are a little bit less, but maybe then they charge more for the lease up. Some properties are a little more, then maybe they charge less for lease up. I like 10%. What do you think on that number, Chris?
Yeah, I mean, I usually use 8 to 10%. I usually like to use 10% because it's simple. And like you said, it kind of helps account for some of those lease up fees, or sometimes those, like they'll charge $100 marketing fee or something.
Right.
Even though a lot of times you're getting charged a lower percentage, those fees add up. Yeah, it's a few more bucks. So I'm very much like, hey, cool, let's say good enough. I'm the ballpark person, because my property management ends up being 11.5% one year. I mean, I'm not going to get the property foreclosed on or anything. It's not going to kill me long term. So
that's right.
I use a very round number, like 10%, like Joe does.
Yep. Now, monthly reserves for maintenance, this is a percentage. I like to use 5% for repairs and maintenance. Now, the reason I like 5% is because I buy a lot of condos. If you're buying a single family home, particularly an older home, maybe something built in the 30s, 40s, 50s, you might need a higher percentage for your monthly maintenance. All right. Now, the way this works, this is not going to be, I'm going to spend $100 every single month maintaining the property. Now, I'm going to have $0 this month, $0 next month, $0 next month, and bam, broken sink. $400 repair or whatever it might be. All right. So this is just your percentage on an annual basis. On average, how much of your rents are you going to have to put in for repairs and maintenance? What number do you like to use, Chris?
similar viewers. So for like condos and townhomes, the things with HOAs that take care of the exterior, I usually use 5% because, hey, they're taking care of the roof, the siding, the sidewalks, a lot of times the lawn maintenance, a lot of the bigger expenses, because you're just responsible for the drywall in. If it's a multi-unit or single family, I'm usually using 8 to 10%, depending on the age of the property. Like I said, it's very different if you're buying a single family house built in the 80s versus a home built in the 30s,
right?
Because there's a lot more stuff in an older home in the 30s. And one of my friends who's a property manager, they've been in business for a long time, manage a lot of units. Actually, Mark Cunningham of Grace Property Management, he shared a stat with me a long time ago. He said, hey, we analyzed 10 years worth of historical data for properties we manage, and all of our expenses and repairs all came out to be about 8.1%. Is basically 1 month's rent per the year that it averaged out to. So I like to use 8% for detached properties, and based on property managers I've talked to, that's a very good rule of thumb, is about 1 month's worth of rent, which is like what, 8.125, I think, or something. So 5 to 8% is what we use, how other people use, but you got to determine what's the right number for you.
So let's plug in 6%, plug in 6.5 for this particular property. All right, great.
Whoa.
Oh, I think you might have to do 0.65. Or
like that?
No. Just type 6.5.
Should probably add 8% to one there.
There
we go.
Yep. All right. So is there an HOA? Let's just say yes.
And there's another yes or no drop down.
Yeah, hit
click no. The HOA box right below it disappears.
No HOA.
Hit yes.
And let's just say it's a condo, and it's a little bit older condo. That's why we picked 6.5% for maintenance. And let's call the monthly HOA dues $230.
And so this is monthly here.
That's right, monthly.
Yeah.
And so now going down here, this is where we're going to talk about annual expenses. So annual real estate taxes. Again, this is a condo. Let's call it $950. Well, it's a $300,000 condo. It's a little more. Let's call it $1,250. All right. Annual insurance for a condo, just your HO6 insurance, just the interior, should be maybe $250 a year. Water and sewer, that's all going to be paid via the HOA, so zero. Trash, electric, landscaping, all paid via the HOA. Anything else on a condo that we might want to include there, Chris?
Typically not. Condos are pretty simple for plugging in here because the HOA pays for a lot of the other expenses. So we usually just look at plug in HOA dues and then taxes, insurance, and the rest is all just blanks or zeros.
Yep. Now the other fields there, maybe you're buying a multi-unit and you need to factor in snow removal. Great. So let's just change that. Let's change other. I know it doesn't apply since this example is a condo, but let's call it snow removal. And let's just say it's $1,500 a year. And then over on the right-hand side, the far right yellow box, let's just put in a comment, say multi-unit snow removal.
So I like this comments to the right and below because these are notes you can put in there yourself to look at later, because I'm guilty of this. Is I'll plug numbers in here, then I'll come back later. I'm like, why the hell did I do this? Or why did I do this? So quick notes help you out. And especially if you're sharing this, like if you're my client emailing me spreadsheets, or you're emailing Joe's spreadsheet, like putting the comments in there helps us understand why you're doing it. So if you're sharing this document with people, whether it's your partner or me as your agent, make sure you put notes in there if it's something that's not obvious, so we can understand, great, well, why did you put $3,000 in $3,000 in here, but it's blank? Like, why?
Right.
And it helps us tell you, like, hey, that's legitimate, or no, it's not legitimate.
Right. So for now, I think it's such a great example. Let's leave the snow removal in here, even though we talked that this is a condo, because this will tie back here in a second. So continuing down, if you wanted to put in any additional notes, you can fill in that field there. And then the very last is just, again, a reminder, we are not CPAs. We're not financial planners. We did consult with our friend James Orr, who runs a software called Real Estate Financial Planner, LLC. He helped us with getting the return on investment quadrant, which we're going to talk about. That's something that he has trademarked, and he's kindly let us use that for the spreadsheet. But really make sure you're double checking all these numbers. Whatever whatever you put in, this is not advice we're giving you. So garbage in, garbage out, guys. Make sure you're using the right numbers. All right.
So before we click over that tab, let's glance over the questions. If you got questions on this spreadsheet, the inputs, type it in here, guys. A couple comments on there about they love the details in the spreadsheet. So thumbs up. Cool. Thank you, guys. One thing before we move on, Joe, because I know this question comes up is like, well, I want to change something in here, change this. Can you give me the password for the spreadsheet?
No. Yeah, unfortunately, you cannot have the password for the spreadsheet. This is a marketing tool that we use. I've spent a lot of time and energy putting this together. You're certainly welcome to change these yellow fields any way you like. But no, this is something that we spent a lot of time putting together as a marketing tool for you guys to use this.
And the other piece to it is, I mean, if someone does get the password to it, they go ahead and change the formula. They email us the spreadsheet back, can't figure out what numbers are on there. And now we're having to go figure out what equation they broke in there. Or worst case scenario, that spreadsheet's passed around to someone else, and they think they've got the original, but it's something that's been changed from the original, and that's caused a huge downstream problem for everyone involved, including Joe and me.
Yeah. I appreciate when folks want to, take the initiative, but guys, I'm not spreadsheet and Excel troubleshooting. My job is to do loans, but I want you to have this tool and use this tool to make sure you analyze properties. So absolutely want you to use it, but no, you can't have the password.
Great. So cash flow tab now?
Yeah. So
this is the fun part.
We've put in everything. Now we're going to go look at our results. So the tabs there at the bottom, and as Chris is zooming in here, there in the webinar, you can see it's inputs, cash flow, long-term analysis, and long-term with cash flow to principal. So we're going to start with the cash flow tab. And what you see is this is now the cash flow analysis of 123 Main Street, which is the property that we're looking at. So our cash investment breakdown is our purchase price of $300,000. Mortgage of $225,000 gives us a $75,000 down payment. And then our finance and acquisition costs or closing costs, $4,740. And it costs $5,000 to repair the property for a total investment of $84,740.
And I want to point out something here because, we include these repair costs in your initial cash investment. Some people do, some people don't. So, this initial repair cost is not money you're usually not bringing to the closing table. But if you have to spend this money so you can get the rents you're plugging in there, well, that's part of your initial investment to get rents of X amount of dollars per month.
That's
so
right.
We calculate that in there when we run the numbers on calculating your total cash in to figure out your return on investment.
That's exactly right. Yep. Now let's look at our annual cash flow. We have annual rental income. So over there on the right, $2,200 a month times 12 months is $26,400 a year, minus 5% vacancy of roughly $1,300. So $25,080 is our expected annual rental income. Property management is $2,640. Repairs and maintenance, $1,716. HOA dues of $2,760, real estate taxes $1,250, property insurance $250 a year. Scroll down a little bit. Snow removal $1,500 a year, and then multi-unit snow removal. Well, now, hey, wait a minute. We said this is a condo, right? So we don't need to have snow removal on this. Let's go back to our inputs tab and take that out, Chris. So this is what Chris was talking about earlier. That's why you want to have those notes there so that if you're sharing this or looking at it with your partner or your agent or whomever it might be, all right, now you can see snow removal is taken out of there because it really doesn't apply for this scenario. We see that happen a lot. If you're copying this spreadsheet, have looked at 3 or 4 multi-units, then I go over, I'm looking at a condo and I'm just going really quickly. That's why you want to put those notes there, remind yourself, hey, that's doesn't apply.
And I'm guilty of that. Pull one spreadsheet, copy, duplicate it, and then plug in numbers and forget to update or take something out.
Absolutely. So total annual expenses for this property, roughly $8,600 a year. So keep scrolling down. Our net operating income, that's $16,464. That's how much this property generates prior to paying the mortgage. And so that's going to be a really important number for us to calculate our cap rate. Then you have your annual mortgage payments, $13,681, and that's broken out there to the right. That's that $225,000 loan at 4.5%, $1,140 per month. Okay. So then over on the left, your annual cash flow before taxes, $2,783. So decent return, profitable property. Let's look at the numbers for our first year return. So cash on cash return is 3.3%. So you see the formula there on the right-hand side is $2,783 divided by our initial investment of $84,000 is a 3.3% cash on cash.
And let me jump in there because we get this question a lot when we teach this live, or people are helping people with a spreadsheet. I like how you've put the formula here on the right hand side, so we can understand the investment. So this 2,783 is your total cash flow before taxes divided by your total cash invested, which is coming up from this number. So your down payment, your closing cost. Then, as I said, we also include your repair costs in there because that's money you're investing in there to get that property.
That's right.
So it's a 3.3% cash on cash return.
Yep, absolutely. Cap rate, 5.4%. So this is your net operating income divided by the total value of the property. So we're just assuming that total value is your purchase price plus your renovations. So 5.4% return. And then one of my favorites, GRM, that gross rent multiplier, that is the total property value divided by the amount of money you can get in rent. And for this metric, lower is better. Now, a lot of people like to use the 1% rule. Oh my gosh, the property costs $305,000. I have to rent the property for $3,050. Chris, do you see a lot of those right now?
No, we do not.
They don't really exist, guys. So wherever you found our podcast here and you're listening to it and you're saying, oh, it's got to be the 1% rule, probably not going to find those in Denver. So I would love to have the 1% rule, but really what you need to think about is that GRM just needs to be as low as possible. It's a quick way that you can kind of do those numbers in your head and say, all right, I'm going to go look at this because it's a 130, 140, 120 GRM, probably a good property to go check out.
Now, we could spend about 20 minutes talking about each one of these metrics here in a lot of detail, but there's a ton of great information out there. So Google it because there's a lot of great websites and blogs that talk about it. And ultimately, which one you decide to use kind of depends on your personal preference. We want to spend time talking about which ones we're using and then talking about the return on investment quadrant, which you'll see in just a couple seconds because that's probably the biggest update to version 6.0. So Joe, your favorite is GRM, right?
That's exactly right. Well, I like GRM because I can do it in my head before I have to look at anything else. So, if it's a $300,000 property and I know it can rent for $1,500, I know that's a 200 GRM, not that great. If it's a $300,000 property and it can rent for $3,000, that's a 100 GRM. Great. I'm definitely going to go look at that. So you can just quickly do that number in your head. Hey, it's a $300,000 property, $2,200 a month. In the off the top of my head, it's about a 140, 145. Okay, let's do some homework on it. All right. Actually, it turns out to be 138, but you can kind of round those numbers in your head. So if it's 200 GRM, you don't want to bother. But if it's something that seems pretty low, absolutely, you want to spend the time on it.
And we've got a question here from Brandon. He says a 1% rule would be a 100 GRM.
That's correct. Yep, you got it.
So that'd be 100. For someone with $100,000 purchase, that would rent for $1,000 a month.
Yep,
100 or 1%. They're inverse of each other.
Yep.
So I hardly ever use GRM. Like, it's amazing. Like, I actually just completely glance over on the spreadsheet, just doesn't even exist to me. I just never use it. My favorite is looking at cap rates, which I get into some fun debates about because, this is really assuming your total net operating income divided by purchase price does not take into account any type of your financing because the loan I qualify for might be very different from the loan Joe qualifies for.
That's right.
And so my financing is going to be different on my cash flow versus Joe's financing based on down payment terms and what I can do based on our own individual credit profiles. But I like cap rates to use that because it actually takes out the individual from the equation and keeps it very, very specific on the property. That way, if we're running numbers or discussing things, hey, whether my credit's bad and Joe's credit's great, the property is still a 5.4% cap rate, regardless of if I've got a 6% interest rate and Joe's got a 4% interest rate.
That's right.
So it makes it very specific on the property. That's why I like to use cap rate. And interesting enough, James Orr, the creator of the return on investment quadrant, his favorite one is cash on cash return. They're all right to use. There's no right or wrong. It depends on what you want to use. And he likes it because it takes into account your individual financing. Well, that's great when you're working with people one-on-one, but when you're doing, a mass trading like this, it's hard to get a very accurate cash on cash because, like I said, my interest rate's different from Joe's interest rate, which impacts that. And then, all sorts of other things. So which one should you use? Well, whichever one you like.
The one you like.
Yeah.
That's exactly right. Yep.
So Oh, go ahead.
let's go down. Let's look at that return on investment quadrant. So we're going to start on the left-hand side here.
So I'm going to zoom in here so we can get focused.
Yeah.
And so we teach a class on this in detail that goes through each quadrant in a lot of detail called the return on investment quadrant, cash flows on everything. Check out the calendar for the class or check out the link. We have just recently did a webinar and we'll post that soon. So you can come to a class or check out the webinar because we spent out 45 minutes discussing the 4 quadrants. Here, we'll be talking about the returns though. So Joe, what are we looking at?
So let's start in the top right, cash flow, 3.3%. That's the same as our cash on cash return. So that is the amount of cash we're getting back divided into the amount of cash we invested. So 3.3%. Top left is that appreciation percentage. Now, that doesn't mean the property is appreciating at 17%. It means the property went up at 5% that we plugged in, but the dollar return divided into that amount of money that we invested, we're getting a 17% return. Then down below that is...
Wait, say that again, Joe, because I know we'll lose people on here because what we're doing here is taking this 80 is to say $85,000 in total cash investment.
Yep.
And then this is assuming when you buy the property, you go out 365 days. So 1 year from when you purchase a property.
Yep.
It's saying how much money have you made in that first year in return on investment. And since we plugged in, what do we plug in here? A 5% appreciation. And a property at 300,000 times 5%, that's appreciating what? $15,000.
Yep.
So then we're taking that $15,000, dividing it by that total initial investment, and that gives you a 17.7% appreciation return.
That's exactly right. That's exactly right. Now, the next one down is debt pay down. All right. This is a nearly guaranteed return that you get as long as you continue to make your payments. This is the debt being reduced every single month. So if you get a 30-year fixed principal and interest loan, every month a portion of your payment goes towards principal, a portion of your payment goes towards interest. Well, that debt reduction is building the equity in your home. And Chris, let me ask you, who's actually paying down that debt?
That's my tenants.
The tenant is paying that.
What everyone always wants, which is OPM. It's other people's money.
That's right.
Buying you real estate.
That's exactly right. And then to the right is depreciation. All right. This comes back into where we had the estimated your effective tax rate. You can depreciate the property over 27 and a half years. And from that, you do get a return in the form of a larger tax return or having to put away less money for taxes throughout the year. So that 2.7 depreciation, that is how much you can depreciate the property times that effective tax rate. So if you look just at the bottom, debt pay down and depreciation, these are nearly guaranteed as long as you A, make your payments, and B, there's no changes in the tax laws, which depreciation has been out there for 30 years, not likely to change. All right. Just add those two together right there. That's a 7% return. Now, that's not talking about the speculation that we have above. Appreciation is speculative. We all know that. And cash flow, I argue, is speculative because it does count on us filling the unit. It does count on keeping the tenant, keeping the unit full, does count on, the appropriate vacancy, does count on the appropriate expenses, et cetera.
Well, it also counts on your tenant paying the bill
the rent.
Even though regardless, great, my tenant signs a lease today. Doesn't mean anything next month if they
don't pay.
They sign for $1,800 next month. Yeah, I can't pay you. Well, great. My cash flow is not $800 a month then.
That's right. That's right.
So it is speculative.
Add all those up, though, that top speculation, you're getting roughly 21%. The bottom, more guaranteed and certain, you're getting 7% return for a total return on your investment of 28%, which I think is pretty darn solid. Do you get 28% in your 401k, Chris?
No.
Yeah, me neither.
I don't get that. If we're getting it from investments, you just really can't get it anywhere. on a consistent basis.
Yep.
So I want to play around, if you're cool with the show. Let's change around the tax rate and appreciation.
Hang on, before you do that, I would definitely agree with that. But before you do that, I want to look at the right-hand side and show you guys, this is how we calculated these numbers. All right. So your cash flow, that 2783, that's the same cash flow number that we had up above,
so that's there. Right here.
Yep. Your appreciation, that is 5% of that $300,000 property. Your debt pay down, that is the principal amount that was reduced on your debt. And depreciation, that is how much you were able to depreciate that property times your effective tax return, your effective tax rate. We're going to combine all of those to get $23,731. That's your total return on this property. Divide that $23,731 into our $83,000 investment. that is the 28% return that you're seeing on the left-hand side. So this new version 6.0 allows us to measure and get a real quantitative number of each of these metrics. So in the past, we were solely focused on cash flow, and we would always say, hey, plus you get the other benefits of owning real estate, such as appreciation, depreciation, tax benefits, debt pay down, et cetera. Now this allows us to really quantitatively measure them and see, is this a good return? Is this a good value?
Yes. And what I always like, what really gets me every time I look at this still is, you still make quite a few grand often from depreciation. And that just adds to your cash flow. I mean, you don't get it every month, but in the year,
At the end of the year,
you're getting it in one form or the other based off your taxes. And that's the really amazing thing when you break it down, these 4 quadrants.
That's exactly right.
Yes, the webinar is being recorded. So we will have this up very soon in the near future. So going back to the inputs here, notice these numbers of 15,000 appreciation and 23 in depreciation. So let's say, I'm more conservative than Joe in this example. Let's say I just want to meet inflation, which is about 3%. And my tax rate is, I'm a, good problem to have, very high income earner at 50% effective tax rate. So I'm paying a lot of money to taxes. Come back here, your appreciation drops from what, a 17% we said to about a 10.6%.
That's right.
So still a very good return. And I'm making 9,000 versus 6,000, but my depreciation rate goes up. I think we're at like 2.7. Now it's at a 5.5%. And your depreciation is now $4,600 a month. So great. I played both variables and my appreciation quadrant goes down, but my tax quadrant went up. And so I'm making more money that way. So this is a fun way to customize it and also make sure you plug in your own variables.
Yep. Now, hey, before you go back,
yes, sir.
Scroll up a little bit. I want to look at the cap rate. So 5.4% cap rate. Traditionally, a lot of people would tell us, oh, that's not a very good investment. Okay, maybe not. But you know what this is indicating is cap rate is the cash flow, right? And then, of course, you get your cash on cash return. Not great cash flow, but one of the things we've experienced here in Denver is cash flows have gotten a little stagnant as properties have continued to appreciate. But this allows us to measure where we're getting additional return, which is through the long-term appreciation of the property, which we've been seeing that appreciation has been outrunning rent growth. So cap rates have been going down, but properties are still going up in value, thus making many properties in Denver a great return. And that's what that appreciation and then the total there in the center, 23.7 ROI, that's really what that's measuring. But it's more holistic than just simply the cash flow or the cap rate.
And to kind of touch on some future content that we'll be pushing out there or teaching is going to be what we call return on equity, which is looking at, great, you get these all 4 quadrants, especially the left side of appreciation and debt pay down, which does increase the equity in your property. And even though some properties may not have great cash flow, you may have a ton of equity. And that's a completely different wealth building mechanism you can tap into to go out there and buy additional properties or to pull cash out or do all sorts of things. And it's understanding this is this ROIQ is foundational. Go out there and play, I call it the adult monopoly game, where after a number of years, you may extract equity or sell a property and do a 1031. Take one property and go out there and buy 3, 4, 5 other properties. So this is beginning with a lot of new content and classes we'll be putting together to help you understand how you can go out there and, great, I'm going to own 1 or 2 investment properties, let the market do its thing, then 5 years own 5, 6, 7 investment properties. So we got some fun stuff coming down the road where this is a foundational course.
Absolutely. So I think this is just a great analysis, that lower appreciation, higher tax bracket. I think that's great. Anything else we should change on there?
I think so. So let me just go back here and kind of change this back to our assumptions of 25% tax rate and appreciation rate at 5%. Mm-hmm. So one thing I want to touch on here, because we just ran this through as a traditional investment property where, I am just putting down a chunk of money, being the landlord, and I am not, just very traditional, but we do a lot of work with nomaders and house hackers. Yep. And these are investors who are like, hey, great, I don't want to put all this money down, or I can't put all this money down. But what their strategy is, and it's phenomenal strategy, is they go on there and buy the property as a owner or occupant. Mm-hmm. So they get access to much better terms on finances. So a lower down payment. So a lot of times that 25% basically goes down to 5%.
That's right.
And the interest rate will drop, 3/4 to a point a lot of times.
Yep.
So I know a lot of people are using this spreadsheet to analyze it. I say a lot because it's me and my clients. We use this, every week I'm emailing clients back and forth. So I want to run through an example on here on how to use a spreadsheet for that nomad and house hack scenario. So let's just say we're buying the exact same property, but I'm going to go move in there as a nomader and put 5% down. And what will approximately be my interest rate, Joe?
Let's call it 3.75.
3.75. So I changed only two things here. I changed nothing about the property. I changed the financing terms. So if Joe's doing it 25% down, I can do it 5% down. We'll show you how to use a spreadsheet. So a couple things happen here. We get some red text over here, Joe. What's going on?
So number one you're getting is mortgage insurance, right? Now you're going to have mortgage insurance. This is assuming you have great credit. The spreadsheet's going to calculate it for you, but it's going to be different for everybody. Mortgage insurance is going to go off of your credit score, your down payment, your qualifications. There's a lot that goes into that. So again, everyone is going to be different. Well, that's why you've got to, give us a call so we go through your individual scenario. And then it's also going to give you a warning that you need more down payment. Again, you can plug in whatever numbers you want, but this really is built for investors with that minimum 15, 20, 25% down. So just see those warnings, understand, hey, this doesn't apply because I'm planning to move into it as my owner occupant. Cool. Just be aware.
And there'll be one thing we have to tweak right now because it is on the to-do list of getting a nomad house hack version out here. But as Joe said, he's not a full-time Excel spreadsheet programmer. He's got life and has to run his business and everything.
And try to do a loan every now and then.
Yeah, he'd actually do that type of stuff. So what happens here that I always like to point out to clients is your loan cost gets very, very high compared to otherwise because the spreadsheet's assuming, great, you're buying this as an investment property, so you got to pay a lot more discount points up front.
Right.
So what we're doing right now until version 6 point whatever comes out is just we're doing a very slight workaround to we want to bring these loan costs back down to about what, $1,500?
Well, so what I would say is your total closing costs on a $300,000 home is probably going to be around $6,000 if you're living there. So what you would do is in your acquisition costs, put in negative $1,240. All right. That's going to give you a total of about $6,000 between those two fields. Now, every person on here can put in their own numbers. If they think they're going to pay more or less in closing costs, fine. Again, it's just important to understand that the spreadsheet in its current form is designed for investors. So if you're using it for a different purpose, I can't send you the password to change it, but that's how you're going to just need to understand some of those workarounds.
Yeah. So exactly what Joe said. It's very simple. Come to acquisition costs, put in a negative number to make the negative number acquisition cost and loan costs come out to be somewhere between, I usually use 5,000 for a rough number. Joe says 6,000. Use either one. It's not going to make a big difference.
Yeah, whatever.
But you can see here, the crazy thing is your total initial investment is $26,000. And then going over the cash flow, because we've changed nothing else on here except for the down payment percentage, the interest rate, and we fiddled with the acquisition cost to kind of give us a more accurate total closing cost. Going back to cash flow now, what do we see? Your total cash investment is about $26,000. Still does the math right. Your down payment, your estimated closing costs, and your repair costs. So you can see here we got that $6,000 we were shooting for. And then coming down here, where is the mortgage insurance?
Right
here we
there.
go. The mortgage payment.
That dreaded mortgage insurance.
So a new line, we did not see this 5 minutes ago or 10 minutes ago, whatever it was, but now a new line appeared for estimated mortgage insurance about $102 per month. Great. Joe, so the spreadsheet says $102 per month. That's 100% accurate for my mortgage insurance, right?
No, that is an estimate. You might have better credit. You might have worse credit. You might opt to put down more money, less money. Thousands of variables literally go into your qualifications. So that is why it says estimated.
Yes. And if you want to get a more accurate mortgage insurance update, I'm going to do help you out here, Joe. Don't call Joe months before you put offers in and months before under contract because Joe can't really give you one until you got the proper under contract.
That's right.
So
because it does change.
Yeah, it depends on a lot of variables. Like Joe sat down one day and showed me the way they calculate it with these tables, and it's a very, very long PDF. It's not just a simple, multiply by 0.02 or whatever. There's a lot of variables in there.
Yep. A lot goes into it. It's just like insurance on your car, right? That's why you have to talk to the agent. That's why they got to go through all sorts of stuff. It works the same way with mortgage insurance.
So if you need a more accurate way to calculate based off your credit score, Come down here, the main page, go to Denver Investment Real Estate /Calc, CALC. That'll redirect you to a handy iPhone, Android app you can download from Joe and Castle and Cook, where you can plug in more specific property details and your personal credit information. I'll give you a much more accurate estimate for what your mortgage insurance is.
Yep.
And you can always come back here and, you can't change that mortgage insurance right here, but you can come down here in this line item and change it. So mortgage insurance, if it's greater, add it in here. If it's less, put a negative number in here and get it close enough. Because if you're off by $30 on your mortgage insurance for the year, it's not going to make or break anything.
Right.
But coming down here, we can see.
Now, hold on a second. This is a negative cash flowing property. Why in the world would we buy this, Chris?
Because we put 5% down.
Oh, okay. Gotcha.
Because we only put $26,000 down versus $85,000 down.
Right.
So I'd rather buy 3 of these versus one of the other ones.
Yep.
So you're right. We have a negative 2.3% cash on cash return. Cap rate and GRM, they're exactly the same because those are 100% property specific.
The property hasn't changed. The only thing that's changed is the terms of the financing.
Yeah, the individual, the investor, you've changed. Now coming down here, this all updates. But here's the crazy thing is you're getting an 84.5% overall return on your first year because you're getting such a high amount on appreciation and debt pay down and depreciation because your down payment, your total cash invested first year is so much lower. So when you divide $15,000, $15,000 divided by what, $26,000?
Yep, 26
is a much higher percentage than $15,000 divided by $85,000.
Scroll over to the right. You're basically making almost $22,000 on this property. And you only invested 26, right? So that's the power of moving into the property, sucking it up, living there for a year, then moving out, putting a tenant in there while you move into the next property. This allows you to invest very, very minimal cash out of pocket and purchase more and more properties, and in the long term, make more and more money.
Yeah. So we can spend hours talking about this. We teach more advanced classes and other classes on just buying properties traditionally as a landlord, and also with a house hacking and nomad. We teach a lot more on that. It's definitely a fork in the road because for most people, you either can or cannot go out there and live in properties as owner occupant. I cannot. My wife and family, I would no longer have a wife and family if I did that. So it kind of comes down to the investor. If you can do it, great. And explore both, but really understand the options that works for you as the investor. So Joe, anything else you want to wrap up here on the inputs and cash flow tab before we go on to some of these? Ooh, there's different tabs on the bottom here.
I think this is great. Let's go ahead and just change this back to a regular investment property purchase, just so it's consistent through all of our analysis here. So it was 25%
down.
Yep. And then I think it was 3,200 and 4.5.
4.5. So we basically changed those 3 variables to go from a nomad house hack to the investment property.
That's right.
So now we're back at what we're doing earlier. Joe, I know this. These tabs down here have changed. There's fewer tabs and some of these tabs are different. What's going on?
That's right. So the first one you want to look at is long-term analysis. So go ahead and click on that. Zoom in a little bit here, not too much, but what you're going to see.
I'm going to zoom in a lot so people can see.
All right, there we go. So your cash investment breakdown to the right, that's still the same. If you can scroll over, there you go. So we're still investing $84,740. Nothing has changed there. And scroll back to the left if you would. Annual rent increase. This is a field that you can now make changes to. I always assume your rents are going to go up 3% per year. Sometimes it's more, sometimes it's less, but let's assume that it is 3% per year. And then year one, that column there is your year one analysis. So that lines up with everything that you just saw in your cash flow analysis tab. So if you would, Chris, go ahead and scroll down to the bottom of that. So what you're going to see, same cash flow, same annual cash flow before taxes, your property value at the end of the year, your mortgage balance because you're paying it down, your total equity, $93,000 in equity, and then scroll down a little bit more. There's your ROI quadrant, your appreciation, cash flow, debt reduction, and cash flow from depreciation, which comes up to that 23,000 and 28% return.
So it's the exact same numbers from the cash flow tab.
That's exactly right.
In year one.
Year number 2. If you'd go back to the top, what you see is the rents have gone up a little bit, because rents are increasing at 3% per year, expenses have gone up. Everything has a 3% annual inflation built in, but some of these are tied directly to your rents. For example, property management is that 10% of your rent. So that's going to go up correspondingly. And scroll down. What's your largest expense that doesn't change, Chris?
It's your mortgage payment.
That's right. Your mortgage payment doesn't change. Therefore, you're making a little bit more money this year.
So I'm going to use my mouse to really highlight this. So I got year one over here on the left. So you got 2783 annual cash flow before taxes, 3277 in year two. And as Joe just said, your annual expenses went from 8616 to 8874, but your mortgage payment stayed the same at 13681, and it's still 13681. And your biggest expense is inflation proof. It's the exact same payment now as is 300 at month 359.
That's right. Yeah, your biggest expense is not going to change. So scroll down a little bit. How does this impact our ROIQ? Dollar amounts go up a little bit. The property is still appreciating at 5%, but now it's 5% of a higher value. So you get a little bit more return in cash, a little bit better percentage return. Then you go over to year three, same result. Things are continuing to improve all the way over as far across as you would like. And I did shorten. I didn't have every year in here, but scroll up, Chris, if you would.
I want to ask you a question on this, Joe, before you can. So I'm seeing this total return on investment. So when I'm in year two here and year three, so beyond year one, this is still taking all this money I'm making and it's dividing it by my initial investment in year one.
Correct.
Right? Okay.
Correct. So this is not cumulative. So I think that's a really good point. Scroll to the left just a little bit. So in year one, I've made 23,731. In year two, you've made 25,142. Add those two together. So at the end of year two, you've actually made what? $48,873. All right. So this is how much you're getting in each single year. So in year two, you've returned what? Almost 60%. So 57.7%.
Yep.
So keep that in mind. This is not cumulative. This is your return each individual year.
Great. All right. So you wanted me to go back up, you said, right?
Yeah. So we're going to go over to the right. So you can see we've got year 1, 2, 3, 4, 5, 6. And then we start skipping some years just to make the spreadsheet easier to read. If you click on see all years, it'll expand that. And Chris, because he uses an Apple, doesn't have that ability.
Yeah. So this is one of those little quirks in the spreadsheet. And again, this is a new feature Joe did. So not exactly top the priority to spend around debugging it to go from a Windows machine to a Mac machine.
Right.
Because if I can't see year 8, it does not make a difference.
So if it doesn't work on your computer, that means just buy a Windows PC.
Is that the way it works?
That's how you solve that.
Problem solved.
So, but then you see year number 10, then you see year number 15, year 20, keep going on over 25, year 30, and then year number 31. This is assuming you make every scheduled payment. Scroll down, Chris. This is where you are going to have the property paid off, and it's now cash flowing $39,000 because you have no monthly mortgage payment.
Yeah, and so you can see that here at year 30, it shows this your mortgage payment of 13,681, and then in year 31, there's no mortgage payment. What happened? Oh, go ahead.
I was going to say, one of my favorite piece of feedback is people always tell me, oh, well, this property is not going to be worth $1.3 million in 30 years from now. Okay, I completely understand your point of view. If you don't feel that that's the right amount, go ahead and just put in a lower percentage for your appreciation. If you think it's only going to appreciate 1%, 2%, 3%, absolutely. That's exactly what you're welcome to customize in there. But the interesting point now is your ROIQ in your last year is only covering appreciation and cash flow. You're not paying down the debt because it's been paid to zero, and you're not getting any cash flow from depreciation because the property stopped being depreciated after 27 and a half years. But you're still making $100,000 a year, almost $40,000 in cash flow, and 64 plus in appreciation. So just a great way to review those properties over the long term. Some years are going to be better, some years are going to be worse, but it just really breaks down and gives you, a good analysis over the course of the year.
All right. So I know a question we always get when it comes here to say, well, great. What if I want to pay off my property quicker?
Okay. So I used to have a spreadsheet or a tab here where you could add just additional principal payments. And what I learned is most people that are buying properties and acquiring them right now, most people that I meet are in the acquisition phase, and they've got a full-time job or full-time real estate agent, or they're getting cash flow from somewhere, and they're buying these properties simply to add to their retirement portfolio. And that, $2,000 or $3,000 a year that they're making in cash flow is not the money that they're living off of. And they have the opportunity to simply reinvest that back into the property. So we put this next tab on here, long-term with cash flow back to the principal. So go ahead and click on that. And so zoom in a little bit here in that far left column, if you would. So what you'll see, same total cash investment, $84,000. And then that far left column there, year number 1, is our cash flow tab again. And at the very bottom, that annual cash flow before taxes, and then that's there in red, all cash flows are going to be reinvested to reduce the principal balance. So scroll down a little bit there, Chris. What you see is your cash flow is now 0%, but your debt pay down has gone up by 3.3% because we took that $2,700 and applied that back to the property. So we're not making any money from the cash flow, but what do you know? Our ROIQ, return on investment, is still exactly the same. We've just reallocated where that cash is going. So this, as you scroll over to the right, will allow this property to pay off much sooner than in the last scenario.
The mortgage payment.
Yep. So you see the $13,681 in there, approximately year 20.
Well, somewhere between, since I'm on Mac, somewhere between year 15 and year 20.
Yep.
It gets paid off.
That's exactly right. So now look at your ROIQ in year 20 there. You're not getting any debt reduction, but you're now getting 34% a year in cash flow. All right. So think about when you want to retire, and if you plug in that principal or cash flow every year and apply it back towards the principal, hey, you could have this thing paid off in 20 years or less. So, if you're 40 and you want to retire by the time you're 60, you can buy 3 or 4 or 5 of these, apply that principal back to the loan. You can retire with 3 or 4 or 5 of these paid off at the age of 60.
And this is a really fun way to, I think, model it, because as Joe mentioned earlier, if you're in the acquisition or accumulation phase of getting your rental properties, what's that, $2,300 a month you're making in cash flow in year 1 of buying this property. I doubt that's moving the needle on your living standards. It doesn't move the needle on mine. I don't need it. So cool. You can either save it and spend it, or you can save it and pay off the debt, or save it and buy the next property. And then this is where we want to start figuring out, hey, how many properties do I need to be able to retire one day? And Joe and I teach a full class on how many properties you need to retire. So check that out on the calendar. We can go into a lot more details on the bigger picture end, where this is very much like, great, how do you analyze a deal that's property specific to buy? But how many properties you need to retire is the big picture that goes more into this to help you put together a very rough real estate financial plan, so you know where you need to go and how many properties you need to buy. So, Joe, what other stuff do we need to talk about in the spreadsheet?
I think that's it. That is everything that's on here. The next step is for individuals that want to download it. You're welcome to use it, plug in your own scenarios. We've done a lot of troubleshooting, but if you do happen to find a bug or find something that doesn't add up, let me know. But I think all of the tabs are working properly. We found a handful of things that if you're on a Mac, 1 or 2 of the things may not work. If you're on Google Docs, I think there's 1 or 2 of the things that don't work. But if you have a regular Microsoft Excel, it'll certainly work just like a normal spreadsheet. Just make sure you click fully enable all of the details, or enable all content, and then everything should work just like a regular spreadsheet for you. So would love to chat if you have questions or anything else we can do.
Great. So where you guys can download this, for those that are watching the webinar live right now, we will send out an email later today with the link. And then if you're watching a future recording of this, we need to update the website and a few other things. We will update all the links on my website, Denver Investment Real Estate. We'll update the links on Joe's website, loansbyjoemassey.com. I will update the links on there. And if you ever can't find the download link, or, gosh, we missed a detail and still have it up in version 5.0 on some link somewhere, just email me, email Joe's office. We're very happy to just do a quick drag and drop and attach it to the file there. So that's the way you can get the spreadsheet. And always keep in mind, stay on one of our email lists, because when we update a new spreadsheet, we will send out an email for it. So I know we got a few questions here that kind of some more advanced stuff that I wanted to address at the end of the webinar. Just we had a very clear and concise tutorial for future people watching this. So a question here from Brandon says, not sure if we'll cover this today or later, but can you show us how we can help use this to help clients determine if it makes sense to hold or sell their current residence? That is a great question. And that's kind of what Joe and I talked about somewhere in here. We talked about return on equity, where, gosh, you might make a lot of money on the debt pay down and appreciation. And that's a very advanced topic. And so we will be doing a future webinar and future class on there to determine, hey, does it make sense to keep it, refinance it, or sell it? And every time I run those scenarios for the first few times, the results did surprise me. So we'll save that for a future class because that's a much more advanced topic, and I'll take a good hour to get into as well. But this is like step one. That's a few steps more advanced. Another question we had here, I think this was referring to the long-term analysis, was is this ROI, total return investment, the same as the CAGR, which is a compound annual growth rate? And I'm not sure, Joe. I'm going to kind of put that on you. I don't think Joe knows either.
I'm not familiar with that.
Yeah, like I know that term when it comes to like, understanding, historical stock data return. And Joe and I don't know enough to compare that to how this ROI quadrant plays out. So, do your own research, or we might be able to figure it out in the future too and help you out. But we wanted to kind of, one of the things I liked about the spreadsheet is you can always get more advanced. You can always add more. So you can always do more things. But Joe has done a really good job of giving that right balance of, hey, great, here are like those 20% of details you need to know. That's like 80 to 90% of the important stuff. And some of that more advanced stuff or wonky stuff, it can just get the spreadsheet way too complicated, because we've got some way more advanced spreadsheets that we can give you. But man, you need to go through like a mini MBA class to sometimes use these. So this is, I think, in my mind, the right balance of simplicity and giving you the key information you need to know so you can move forward with buying a property today. All right, guys. Thank you so much. Appreciate you coming out. And if you have any questions in the future, again, I don't own the spreadsheet. That is Joe's spreadsheet. So always, let him know. If you're my client, though, email me directly. I always work with clients on analyzing specific properties. And again, no password will be given out for the spreadsheet. I want to beat that dead horse down for Joe's sanity reasons.
You're welcome to ask. The answer will be no.
Yes. So you know now. All right, guys. Thank you so much. Have a great day.
Thanks, guys.